Welcome to The Explainer. We're all about breaking down tricky subjects into something you can actually wrap your head around. So today, we've got a real accounting puzzle for you. If a company's investment doubles in value, did they make a profit? You might think that's a simple yes, but it turns out the answer has everything to do with what the company was planning to do. And believe me, it changes everything.
All right, let's set the stage with a really simple scenario. Imagine a company buys a bond, and a year later, its market value has literally doubled. Sounds like a huge win, right? So the big question is, did they actually make a profit? Your gut probably screams, yes, of course they did.
Well, hold on. In the wild world of accounting, things are rarely that simple. The answer isn't a straightforward yes or no. In fact, if you ask any accountant, you'll probably get their favorite answer for just about everything. It depends.
Okay, so what does it depend on? This is the interesting part. It's not about the math or some complex formula you can plug into a spreadsheet. Nope, it all comes down to one single critical factor: management's intent.
Yeah, you heard that right. The official rules, US GAAP for those keeping score, they care about more than just the numbers. They actually make a company categorize its investments based on why they bought them in the first place. That one question, what's your plan for this bond, completely changes how it shows up on the books.
So first up, we've got the long haul category. These are called held to maturity, or HTM. This is for when a company buys a bond and says, we have both the intent and the ability to just sit on this thing until it's fully paid back. They're just going to collect their interest payments and wait for that principal to come back, maybe years from now.
Now, on the total opposite end of that, you have trading securities. This is all about playing the short game. The company bought this bond with one goal in mind: to flip it fast and make a quick profit from those day-to-day price swings.
And then, smack dab in the middle, you've got this really important third category, available for sale, or AFS. Now, these aren't for quick flips, but the company also isn't promising to hold them forever. The idea is, yeah, we plan to hold this for a while, but, if we need some cash, or if the market conditions are just right, we might sell it. It's all about keeping their options open.
So get this, it's the exact same bond, but because of these three different intentions, you end up with three totally different stories on the financial statements. Let's walk through how each one plays out.
Let's start with path number one, the set it and forget it path. This is for our held to maturity bonds, and the whole philosophy here is pretty simple. Just ignore all that daily market chatter.
The logic here is really the key. Think about it. If you're never going to sell before the end date, who cares if the price goes up or down in the meantime? It's all just noise. So that huge gain we talked about, the bond doubling in value, for accounting purposes, it's invisible. The bond just sits on the books at what it originally cost, or something very close to it.
All right, path number two, the quick flip path. This is for our trading securities, and the goal here is the polar opposite. We want to capture every single up and down in the market.
With trading securities, you're trying to show what's happening in real time. So the bond's value on the books is always updated to its current market price. And that big gain, even though they haven't sold the bond yet, which makes the gain unrealized, it flows straight into net income. It makes the company's profits for that period look a whole lot better.
And that brings us to our third path, the maybe someday path. This is for those available for sale securities. And honestly, this is where things get the most nuanced and maybe the most interesting.
Okay, so think of this as a hybrid. Just like a trading security, you update the bond to what it's worth today. So that doubling in value, it gets recorded. But, and this is a huge but, because the company isn't planning to sell it as part of its core business, that gain is kept separate from the main profit number, from net income. Instead, it gets put into this special holding pen, just kind of waiting on the sidelines.
So let's just pull back for a second and see where these profits actually go. I mean, we're talking about the exact same bond, the same massive jump in value, but we end up with three completely different pictures of the company's performance.
This table really brings it all together. For our bond that doubled in value, if it's held to maturity, you see it on the books at its original cost, and poof, no gain is recognized. If it's a trading security, bam, it's at its new higher market value, and that gain goes right into net income. And if it's available for sale, it's also at that higher market value, but the gain gets funneled into this other place, something called other comprehensive income.
And you might be thinking, wait a minute, what on earth is other comprehensive income? That is the perfect question, because understanding this is absolutely key to getting the real story behind a company's financials.
Right, so we all know net income. It's the bottom line, the number everyone talks about.
But think of comprehensive income as the comprehensive picture. It starts with net income and then it adds in these other specific gains and losses like the one from our available for sale bond. It's just a broader, more complete look at everything that changed the company's value.
Here's a good way to picture it. Think of a company's equity, its net worth, as having two different pockets. All the profits from net income, they go into one pocket, called retained earnings. But those other special gains and losses from other comprehensive income, they go into a second pocket, called accumulated OCI. They're both part of the company's total value, but they're kept separate until that investment is actually sold. Okay, so this all might sound like a bunch of accounting jargon, but why does any of this actually matter to you? Why is this so important for anyone trying to figure out if a company is healthy or not?
Well, it matters a lot because it helps you figure out the quality of a company's earnings. See, net income should tell you how the main business is doing, the profits they can hopefully make again and again. But OCI, that captures gains and losses that might not stick around. They could disappear tomorrow. This whole system lets you see if a company's record earnings are because they're crushing it in their core business, or if it's just because they got lucky on an investment they haven't even sold yet.
So, at the end of the day, these accounting rules aren't just there to be complicated. They're actually giving you a peek inside the minds of management. It tells a story about their strategy. Are they a patient, long-term investor, a short-term gambler, or are they trying to build up a cushion for the future? It really is the story behind the numbers.
And that really is the key takeaway here. The next time you see a headline about a company reporting record earnings, you'll know to dig a little deeper. You can ask yourself, okay, where did that profit really come from? Is it from their actual business operations, or is it a paper gain on an investment? Is it in net income, or is it tucked away in OCI? Now you know how to look for the full story.